Hi, and welcome to the special edition of the Macro Show, Kingdom Under Siege. Yes, my loyal fans, the kingdom is under heavy siege, but are our enemies about to become our allies? In this show, you'll find out. Plus, we're going to take a look at the credit data, try to determine if indeed a blue wave is inflationary, or if the markets are maybe moving for some other reason. We're talking about the worst December payroll report in a decade and what's going on in the kingdom, what's going on with these quants, why are they selling? I'm your host, Steve Van Meter, and thanks for joining me today, because one thing I've said is the price action in bonds. And I want to address this because we're going to tie this right together with, is this blue wave inflationary? As I've said, since August, it's been quantitative computer models selling bonds, and people have actually said, "Oh, you're just blaming the computers when things don't go your way." Now, many of you know I provide a lot of hard evidence to my views. I'm sure there's some things I make up, and I'm sure there's some views that I have that are that of my own, because I interpret the data the way, well, I see it. But when I said the quants were selling, I was right. So I want to get into that, but in a moment, and I really want to dig into that, and then we'll come back to the economic data, the credit data, and all that good stuff. But let's talk about the election, right? So we had the Senate Georgia elections go through. Both Democrats won, and what did the market say? Oh, well, it must be inflationary because, oh my God, yields are going up. They're breaking technical levels. And that means interest rates are going to go, I don't know, probably 3, 4, 5, 7%. I mean, this is it. The Democrats, they're going to create inflation. Well, that it's really hard for politicians to create inflation. And speaking of politicians creating inflation, that was one of the questions on my Real Vision interview with inflation expert, or as he calls himself, the inflation nerd, Mike Ashton. It'll air on Wednesday, coincidentally, at the same time as the CPI. So there are a lot of your questions are in there. We talked about shadow stats, Chapwood, all that good stuff. The dollar, the chance that Steve could be right and the CPI go negative. Well, Mike weighed in on that end, what it would take for me to be right about that. You won't want to miss that. So here we see the market saying, okay, look, right? There's going to be all this inflation. We're broken out of a technical range. We're at the highest yield since March. This is it. This is the big move we've all been waiting for. But maybe, what if I told you that the outcome of the election didn't matter? This would have happened anyways. I say, nah, there's no possible way. What if two Republicans would have won, we would have seen the same thing. If one Republican, one Democrat would have won, we would have seen the same thing. If the election actually ended up in a tie down to the last vote, would have seen the same thing. Now, how's that possible? You say, well, we're going to go take a look into the into the bond futures. And our friend Stefan, he already messaged me, said he'll send us some charts over the weekend for the Monday show. So hopefully he'll run the 30-year, and you're gonna see why I'm gonna ask him to run the 10-year net short. Check this out. So this is hot off the press from the Commodity Futures Trading Corporation. We're going right into financial futures as of January 5th. So when was January 5th? Tuesday. When did we get the election results? That night. Now, so keep this in mind. When this was closed, when the CFTC, got all their data, we did not know the outcome of the election. The polls would have still been open. So let's see what speculators did. Well, in the long bond, they added 15,500 short positions. Now, what I thought was interesting is the dealers backed off. I was like, well, maybe the dealers added positions. No, they backed off some of their short positions. But the speculators, the hedge fund managers, they added a bunch of longs, and as did non-reportable. So these are small positions. They added 13,000 short positions. So people went into the election on the long bond short. How about or increasingly short? How about the ultra long bond? Well, short non-reportable positions. These are going to be your small time, investors, not large hedge fund managers. Big increase in short position. Added 10,000 contracts to 144,000. This is huge. Speculators backed off 9,000, dealers backed off 3. So you can see a lot of speculative money being bet on the outcome of this election. How about we go to the 2-year note? A 10% increase in short positions, almost 82,000 contracts. That's huge. I mean, that's massive. So you can see just how short this is. You have 1.9 million contracts out there, 852,000 short position by the speculators. Incredible. How about the 10-year? They backed off that a little bit by about 15,000 contracts, and then the dealers backed off around 41,000. And we can look at the ultra 10-year. They increased those position speculators by 4,700. Let's go back to the 10-year. Look at non-reportable shorts, increased 35,000. So what you have is a massive amount of small bets that interest rates were going to rise the next day. Now, sometimes what comes up is people always, they'll call me and say, well, Steve, what drove the market today? I don't know. I mean, nobody knows what moves markets in a day. The news is always trying to figure out what the market is doing. Remember, the market makes the news. The news is just trying to figure out what the market was doing. So what we have is what looks like the market saying, wow, there's going to be massive inflation. Those bets were already placed before the polls closed. This move would have happened anyways. And so what you saw in the bond market is this massive just unloading, and it just brought the long bond, the intermediate bond, everything down overnight because of all this heavy speculative positioning, and a lot of it is from really small players. Plus, we're going to talk about the big enemy, the CTAs, the Quants, and what they're doing. So now we see prices are trying to firm up. There was a lot of volume traded that day, on the day after the election results. What looked like stopping volume, and then more selling in the overnight, and then more selling in the overnight again. And what is driving all of that selling is the CTAs. And this is something that I've talked about, and I want to show you. Now, this is an article from, unless I cleared it, I must have. This is from an article on Zero Hedge, and from Nomura. And Nomura is a large bank, a large primary dealer bank, and they have these quantitative computer programs where they trade based on price level. Now, this is proprietary information, which is why it is only occasionally published when someone at Nomura chooses to do so. And it's not something, unless you're a credit investor and have a massive amount of money there, that you can actually get the daily updates, which is why I don't have them, because I don't have an account at Nomura. Anyways, let's take a look at what's going on here, because this is really, really interesting to me. Is there's so much money, and I don't know how much, but there's so much money in these CTA or Quant programs that they're effectively the bond market. And what these things do, and I think I mentioned this before, is they trade based on price level. So they're not reading the news, they're not looking at economic data. It just says if price is rising, momentum is increasing, well, buy. And if price is falling, sell. And if prices fall too much, go short, and if prices go too high, go max long, go take extra risk on the position. And so the phrase buy the dip, these programs do that. So when momentum and prices are rising, they buy the dip. And when prices are falling, they do something called sell the rip. So when prices go up and then they sell it down, prices go up, sell it down, which is exactly what we've been seeing since August on the bond market. So let's go take a look at what's going on here, because this really explains pretty much everything that's been going on. So let's go back in time, because I want you to understand how this all plays out. Now, the first time I talked about this was over a year ago, and let's zoom out, during this event right here. So we'll zoom in on this. And this was a consolidation pattern that everybody interpreted based on its technicals that it was going to go lower. And I said, no, it's not going to go lower. It's quant selling, because I had some information at the time to support that. And then the Fed comes in October of 19 and starts doing quantitative easing, mostly in T-bills. And I knew, okay, this thing is going to eventually turn higher. Now let's look at the quant positioning from this article on Zero Hedge. And what you can see is they were max long kind of around August, September. You can see up here at the peak. So the CTAs were long. And then over the next, say, 6 months, August through January, they exited all those long positions, sold them, and went effectively net neutral. I mean, not quite, but it got really close to neutral. And then bond prices started to rise. And what happened, now what you're seeing here in black is 10-year Treasury yields inverted. Bond prices started to rise. We'll flip back over. So what you saw is this whole move here for 6 months, sell, 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 buy the CTA, sell, sell, sell. And then bond prices started to rise as they pretty much ran down to neutral and their selling backed off. And then what happened? They became buyers because what changed? The trend, momentum changed. Now this is really interesting to me because you have effectively someone who's laying siege to the bond kingdom one day and then perhaps a week later or even two, now is your biggest ally. Isn't that interesting? Let's go back to the article and look at some other positionings on this. So now here you see in January, they're fairly net neutral. Fairly net neutral. Bond prices start to rise here, inverted Treasury yields. So we're seeing yields fall. And all of a sudden the CTAs come running back in. And they go max long at 2 different points. Now let's go back to the chart and see. So what happened, again, is the CTAs exited the bond market and then chased this whole rally up to here, backed off a bit, and then chased it up to here. Let's go back and look just so you can see that. See, there's a peak, there's a second peak. The second peak in August, they were max long. And then what happened? Their program switched to sell. And so they've been selling down this entire position here. Sell, 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 sell. Now, how do we know that? Well, we can, again, look for a very consistent pattern called sell the rip. And how do you know what sell the rip is? Simple. Price goes up, gets hammered down. Prices go up, hammered down. Prices go up, hammered down, up, hammered down, up, hammered down. And it does it in the overnight, in the pre-markets, up, hammer down, hammer down, hammer down. And you can see it as we even zoom in on the 30-day. Just every move up, hammer down, 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 and then super slam as whatever happened that night during the election must have triggered even more selling on top of the speculators who were lined up ahead of the election to short the bond market. And then if we zoom in over the last 10 days here, you can see rise, slam selling in overnight, rise, selling. Rise in the overnight, slam in the pre-market, sell, 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 rise, sell, rise. So what you're seeing here is these CTA programs have so much money that you'll notice that they are effectively the bond market. And now they're back almost at a net short. Maybe they are now net short as of today. I don't know. Maybe they're even slightly short at this point. I'm not sure. Because again, we don't get daily updates. There's no way to get that for us. But what I do know is when these positions change, when these CTAs start to buy, guess what's going to happen to interest rates? So we look at this blue wave and everyone thinks, well, it's going to be inflationary because look at the markets. And what you're just seeing is heavy speculators selling, right, the night before, plus computer models which are telling their programs, are telling them, hey, we need to get out. We need to get the last of this out. And so they've sold. But since these are trend following and they don't care why the trend is moving the way it is, all they do is follow the trend. That there is a possibility in the near-term future if bond prices turn around, which they can, and because how did they turn around back in January? Well, it's simple. If we zoom back out, what was the catalyst here for bond prices to rise? Well, you had QE going on, you had tight financial conditions, so that you had all the recipe that bond prices should have been rising, but there was a persistent sell under them. Every time they went up, someone came in to sell them down. And once that selling had subsided and the quants got to a level where they're like, hey, we don't really need to sell anymore, now all of a sudden price could rise as it needed to. And what do you have in here? Just massive selling across this. Now, I also meant to pull up the net short position chart, so I'm going to go do that really quick while you hang tight on there. And let's see here, 30-year speculative positioning. Okay, now check this out. Let's look at the comparison. So the first time back in January of 19, where were the speculators? Well, they were in slightly net short. And as prices rallied into August of this year, 2020, so we're going to be right in here, we see the speculators increase their short positions. Almost doubled them. And now they've doubled plus them again. So what you still see is massive, massive selling. So I want you to think about this. For anyone who says, well, there's no way this bond market can turn around. When these quants finally calm down from all their crazy selling, you have the recipe thanks to quantitative easing, because quantitative easing is designed to pull bonds off the market, suppress interest rates, to start getting bond prices to rise. Now, what will then happen next? Well, those momentum CTAs, right? These quants will start to say, oh, hey, prices are rising, right? Hey, so what do we do when prices are going up? Well, we flip back to buy. It's not like they have to wait, 6 months or a year. It's like, hey, the trend is going up. We're going to buy it. Well, they have so much power behind them that they're going to move the market. Now, they're going to move this into a position where you have this massive speculative short position, which probably is even shorter when we find out in a week from now what was going on due to all the shorting going on before the election. So you have, and then you have another factor. The Fed has been removing 30-year bonds from the market at a clip of around $5.5 billion a month. Now, next week we have the 10 and 30-year long bond auctions. We've seen really strong bidding. Do you think the bidding is going to get even better at these yields? Probably, because so what's going to happen is the Fed's going to continue to reduce the overall supply. The quants are going to calm down and stop selling. They're going to go neutral, kind of back out of the kingdom and just hang out doing nothing. Prices of bonds should rise as everyone that's speculatively short can be short. The quants are then going to see, hey, prices are going up. We better buy back in. And now they're going to start buying into a smaller market than they sold out of because of the Fed. And then all of a sudden, what will happen with the futures market? All those shorts will start to get squeezed. Interest rates will start to do what? Go down. What will that start to indicate? Tight financial conditions. Will the Fed then, at their meeting this month or next month, we heard them talking a little bit about shifting their purchases out the duration curve. If they do that, that'll mop up even more of the long bond supply. And what you have is a recipe. I did all the math wherever it is here. The last time, so let's go back and look at these charts, is what we saw is this move here from January up to here was about 1.2%. Which, if we see a similar move from right in here, takes the long bond yield somewhere down to 0.65, 0.67%, new all-time lows. That move here, this move here in yields, down to right here, was done with speculators shorting it. What if the speculators now are unshorting and going long to cover this big move down? And what if all these people are buying into a smaller bond market because of the Fed? And what if all these pension funds that are net short? And what about all these institutional money managers that don't own any bonds? What are they going to do if everything turns? So is this really inflationary? Well, the answer is no. The market was just positioning, thinking it was. And if it holds out here under all this volume and can start to rise, well, that's where you'll start to see these gap up movements back, just like we saw in January. Gap up movements along the way. Why? Because the CTAs were buying back in. Massive squeeze. That's why some people say, well, Steve, why didn't you just get out? Go buy equities. I could go buy something I know is at its all-time record high, market cap to GDP, and hope it goes higher and hope I'm fast enough, smart enough to sell before it goes down. Could go to cash, but I don't make a dividend. Bonds at least pay me a dividend. And when this reverses, it's going to reverse fairly quickly because all of the massive speculative shorting. So why get out? All right, so let's move on to, I know we got a lot of stuff, and I covered that. Oh, actually, there's some more about that I wanted to go over here. Here you see CTA net positions of major government bond futures. Well, they're short Asian bond market already, so if there's any risk-off move, those could turn long. You can see U.S. and Canada, they're fairly net neutral. and they're still slightly long European bond futures. So that's very interesting. As far as anything else going on, you can see how long they are on the Dow and on the NASDAQ. So these computers have been buying a lot. You can see they're almost near their max long position on the Dow. I mean, you can look back here to August. You can see just how long of that position with the NASDAQ. I mean, clearly they could go a lot higher. So if anyone's wondering about that, let's get into the economic data. We've got Japan overtime pay down 10.3% year over year. Well, that's not going to be inflationary, right? Less money, not really in pockets of workers there, not going to really turn into much inflation. How about preliminary CPI coming out of Italy? Still deflationary at minus 0.1%, a slight improvement, but still deflationary. How about the overall Eurozone? CPI year over year flat at minus 0.3%. Again, deflationary, excluding food and energy, no change at 0.2% on the preliminary data for the Eurozone there. So you start looking at the fact that where's all this inflation that everybody's looking for? It's not showing up. How about challenger job cuts? 77,000 jobs on the cuts. Very rare for December. Telling you employers are wanting to get rid of employees. And on that note, what did we have? Initial claims came in at 787,000. I didn't have pandemic. I don't have that pulled up. The pandemic claims. What happened there? Well, they went down slightly to in the 19.5 or 19.6 million range. What we're seeing in that data is people retiring. They're not even bothering to file claims. They're filing for their Social Security and pension benefits. Let's move on into the ISM data. So this is the services sector or non-manufacturing. The headline index came out pretty good, 57.2. Continued expansion. The rate of bit is slowing a bit. Still beat expectations. But what's going on under the covers of the ISM? Business activity and production continue to go up. New orders continue to go up. But look at this employment. Slight contraction. So effectively no change. So employers are saying, look, we're getting more orders. They're increasing at a little bit faster rate. Activity's doing good. What else have we got going on this good? New export orders are up, and we're not adding employees. Now, why might that be? Because inventory levels are getting too high. And you say, well, look at supplier deliveries. There's a big backlog in demand. No, this is due to COVID causing slowdowns in the supply chain. How about imports? Well, they're starting to flatline out, and the overall inventory sentiment is starting to turn negative. Meaning, what happened is you see that in the services sector, a buildup of inventory. Remember, everyone thought inflation's coming. If you build it, they will come, and they're not coming. Let's move on to what else we got here. German exports. That's on a month over month. I like the year over year. So I know we're going to go way over on the show time. So I apologize for that for any of you who had some plans when you sat down to watch the show. Non-farm payroll report minus 140,000. Do you know the last time we had a non-farm payroll report that went negative in December? Well, that would have been just after the great financial crisis. We have not had one for 10 years. That is terrible. It tells you the economy is rolling over. You can see it right here in the data. I'll zoom it in. If you can't see that, you can see it's rolling over. It's not something you want to see. Normally, Decembers are strong months for hiring. For obvious reasons, I don't need to explain that to you. Average hourly earnings were up 0.8%. Now, this looks really good, but when you find out that this was skewed because a lot of lower paid employees were sent home and on unemployment, that doesn't look that great. But the average hourly earnings for those who stayed on the payroll were up 5%. Weekly hours down slightly to 34.7. Keep in mind now, here in January, there are a lot of minimum wage increases are going in effect. Be curious to see how many of these jobs eventually do come back. Participation rate at 61.5 unchanged, whereas my labor force participation rate chart, hey, this doesn't look like an economic recovery. This looks like it's rolling over. Remember, when we looked at Treasury yields against this, what did it say? Well, it says that Treasury yields should be heading lower. And a lot of people think, well, once this is all over, all these jobs are coming back. Remember, folks, here's an inverse of government debt. Government debt is a cancer on the private economy. Best estimates right now say 6 million jobs are not coming back. Who knows? Maybe more, maybe less. But the non-farm payroll report overall, not that great. What do we have? One more chart on that. Average weekly hours of production in non-supervisory employees times the average hourly earnings of those employees in the number of employees in the manufacturing sector at production and non-supervisory level. And you can see nowhere near pre-pandemic levels, nowhere even near the levels of expansion before, suggesting that there isn't a major recovery going on. This is total payrolls in the production of non-supervisory employees, total payrolls, and it's below. So people talk about pent-up demand. They talk about, oh, people are flush with cash. And no, their incomes are lower than they were before the pandemic, potentially why, have all this talk about stimulus going on. All right, what else we got in the data? Let's go through that. We covered. How about, I do want to get to the M2. Let's go through the M2 first. What's this? Oh yeah, we're going to talk about that. I know, all over the place because my interview with Mike. Let's go to the PowerPoint, which I obviously need to put into PowerPoint mode. Okay. M2 money supply, 12 and rate of change is at 24.38 and rising. And even though the 6-month and 3-month rate of change is rising, the last couple of weeks, the money supply has gone down. Now, where is it going? Well, that's a good question. Let's pull up the money stock measures and take a look. And we can see savings deposits are up a bit. It is demand deposits that actually took the biggest drop, and institutional money funds, which is normally goes down when you see people buying stocks, has gone up. Looks like some people sold out and put money in cash. Normally, when you see this rising, that's very bond bullish. So what does this mean? Well, when you see the M2, which is now, we see it turning down. So we'll pull back up that chart of the M2. We'll put it into billions of dollars so we can see. And I don't believe this is a long-term move down because normally it doesn't happen. But you see it headed down for 2 weeks in a row. Now, when you compare that to the money multiplier, which is the M2 divided by the monetary base, what we find out is the M2 grew, 70 or $80 billion in December, somewhere in that range. The monetary base, thanks to QE, should grow at least 120 billion, maybe more. Now, there's all this belief there's going to be massive amounts of inflation, but what we can expect is the money multiplier to actually decrease. So when we get this, now we're going to get the money multiplier data probably Monday after we record the show, because the monetary base data, the charts are usually updated later. Maybe I'll delay the show just for that. But what the expectation is in red now is the consumer price index is going to go up. I mean, it's always the expectation that we're going to see inflation. And these two are pretty tightly locked together right now, and they're not normally that close together. But if the money multiplier in blue heads lower, it's not a positive sign for the consumer price index. So it'll be very interesting seeing what that looks like when that comes out on Wednesday. All right, let's go to the assets and liabilities. All commercial banks, we see bank credit up $28 billion as banks are trying to continue to fill in a hole from lending. Remember, no one wants to buy bonds. Well, securities and bank credit rose $21 billion, with the mortgage-backed securities up 20 and U.S. Treasuries up a mere 3. How about loans and leases? All commercial banks, whopping $5 billion increase. Residential real estate up $1 billion. That's not good. Now remember, this is a week ending December 30th, so there's likely to be mortgage payments in the next week's data. Commercial real estate, no change there. Consumer down $3 billion. Credit cards down 5. What's the fastest thing growing on the bank balance sheet right now? Cash assets. Up 79 billion. People talk about all this demand, all this money that's going to get out in the market. It's not getting out into the market. It's sitting there. All right, let's go on to the last of the charts. Real estate loan growth down to 0.93% from a year ago. Residential real estate is in contraction. 6-month rate of change and 3-month rate of change are both negative. That means money is being destroyed. Commercial industrial lending, growth rate is up slightly, but this should turn negative sometime in March. But the 3 and 6 month rate change says money is being destroyed. Now, maybe that is part of the reason why the M2 is not going up that much. Loans and leases, all commercial banks, growth rate is up 3.5%. But due to all the other indicators, the 6 month rate of change is down to 2.15. 3 month rate of change is at negative 0.83. That is telling you that money is being destroyed. How about credit card loans? We know they're getting paid down. 3/4 of all stimulus checks, guess where they go? Pay off credit cards, down to 11.6% from a year ago. You know, if people say that consumers want to go out and spend money, when they do, they charge their credit cards. What is this telling you? They're not charging on their credit cards. They're paying them down. With that, my friends, I know we are massively in OT here, but I thought going through that quant data was really helpful to show you that while the kingdom remains under siege, our biggest enemy might become our biggest friend. And with that, I will see you on Sunday for the weekly chart show, and then back on Monday for the macro show. I'm Steve Van Meter. Thanks for watching. Bye now. The content of this video is provided educational information only. Is not intended to provide investment or other advice. It not to be construed as recognition or solicitation by or security transfer instrument or to participate in any particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity opinions expressed in this video that I'm doing do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.